Consolidating your credit card debt into a single loan can be just what you need to be able to breathe a little easier and move down the road to getting out of debt. But you've got to make sure you do it the right way. Otherwise, it could make things worse. So I'm going to walk you through the process and explain where things could go off the rails at every step. The idea is to ensure you're making progress towards a debt-free life. One of the most common mistakes people make when they decide to consolidate their credit card debt is that they consolidate with a company that isn't actually giving them a better option. Sure, they only have one bill now, but consolidating didn't do anything to help them get out of debt faster. And that's really the whole point. You want to save money on interest and apply those savings to paying off the principal faster. That's the whole point. So to avoid trading one bad debt for another, you need to know how to compare the offers. Gather the following information about your credit card debt: the current balances, the minimum payment, and the interest rate. With this information, you can figure out what your effective interest rate is across all of your debts. In this video, we will walk you through how to do this in detail and where you can download a spreadsheet with the formulas already built. But if you don't want to do the calculation, a quick and dirty approach is to ensure that you are never consolidating any debt that has an interest rate that is lower than the APR offered on the consolidation loan. Don't just compare the interest rates. Remember that origination fees or balance transfer fees will be included in the APR of the new loan. Those fees are part of the cost of consolidating, so you need to account for them. And if you hope to pay off the loan early, you will want a loan with a low origination fee. When you pay off your loan early, you won't get a refund on your origination fee. So your effective APR will be higher than your stated APR. Now that you know how much you need and you know the APR that you need in order to make consolidating worth it, now it's time to find out what you could be approved for. Now, I recommend you apply for several loans. In fact, I actually recommend that you get approved for at least 3 lenders. Why? Well, each lender has a different criteria for deciding whether to lend you money, and you might qualify for a lower rate with one lender than you would with another. At the Yukon Project, we try to make shopping around easy. We have a page where you can see different lenders, but the really cool thing is that you can apply with any one of them, and we will check with all of the lenders to see which one would offer you the best rate. The application doesn't affect your credit score, so you can be sure that you're going to get the best deal you can qualify for. Just a quick note about the offers you might get from loan consolidation companies. Pay close attention to the APR as well as the total interest expense. A loan with a lower APR may actually cost you more in interest in the long run if the term is longer. So you'll want to pay attention to both the APR and the total interest expense. Both of those things will be found in what's called the TILA box, which will be presented to you with every offer. Just because a company offers to consolidate your credit card debt, it doesn't mean you have to take the loan. Now that you know what you can qualify for, you need to evaluate whether consolidating is better than other options. The 4 options you should think about is accelerating the payoff of your current debts, transfer the balances to a single card, use that debt consolidation loan, or take out a home equity loan. The first option you should compare is paying your current debts faster through the snowball or avalanche methods. This can be one of the best options, but it is hard to accomplish if you are currently struggling to afford your current payments or if you have a propensity to just pay the minimum payments. Balance transfer is where you move all of your credit card balances onto a single credit card, often a new account. Some credit card companies will offer you 0% interest for an introductory period if you'll do this. This means that you can save a lot of money, but only if you take the time to make as many extra payments as you can during that introductory period. If you just make the minimum payments, you aren't actually solving your problem. You're just shifting your debts around or postponing the inevitable need to pay off your debts. And as we've mentioned earlier in this video, debt consolidation or personal loans can immediately lower your payment and force you to make steady progress on paying off your debts. but it isn't worth doing unless the APR offered is several percentage points lower than the interest rate you currently pay. Finally, a home equity loan might be the lowest cost option because it would be a secured loan, but that's also one of the downsides too. The other downside is that it could extend the life of your loan significantly. It really depends on the terms of the loan. If none of these options feel like they would work for you, you might need to seek professional help. You can get specific and personalized advice from a debt counselor. Make sure you find one that works for a nonprofit organization. You can find one through the Financial Counseling Association of America or the National Foundation for Credit Counseling. You should be wary of debt settlement companies or for-profit debt relief companies. They can be expensive and leave you in worse shape than you would have if you hadn't used them at all. The last thing I'll say is you've got this. With a plan and some discipline, you can make meaningful progress towards a better financial future. If you found this video useful or interesting, please like it and subscribe to our channel. Thanks for watching.